Welcome to this week's version of Nickels and Dimes, our weekly video series. The quote of the week this week is actually an old school phrase. We've heard it for many years. And it talks about what you don't know can't hurt you. And I agree with that on some level. What you don't know can't hurt you. But on the other side, what you don't know can hurt you. In today's financial tip of the week, we talk about the bond market. So bonds are effectively debt instruments. So they're issued by institutions, municipalities, the Treasury. Our government issues bonds, so you could invest in them in many forms. And obviously, you invest in an individual bond or a bond fund, you get an interest rate in return. And if it's an individual bond, you wait to the maturity date, you get your money back to the extent they're in business. Of course, if it's a bond fund, then you get some interest, and your value will fluctuate with the fund value. So that's all well and good. Well, for the last 30 years, the bond market has generally been one of the safest places to invest. Again, not specifically junk bonds, but government bonds generally are very safe. Many corporate bonds are very safe depending on how highly rated they are. And of course, the municipalities on average are very safe. So again, the bond market has been a very safe, on average, asset class to investment for the last 30 years, but interest rates have come down. So interest rates have come down over the last 30 years. And when interest rates go down, bond values go up. So obviously, with rates coming down the last 30 years, bond values have gone up. And for many, many years, people have been talking about a bubble in the bond market. Now, most people talk about the stock market and how well it's doing or well it's not doing, but no one really talks about the bond market. And the bond market, by the way, is larger than the stock market. Most people don't know that. So what am I talking about? What is the risk or concern with the bond market? Because rates have come down for the last 30 years and bond values have come up, there is a premium to invest in bonds now. And many people believe there's a bubble in bonds. Now, coupled with the fact that the Federal Reserve is, the last few months printing money electronically, interest rates have come down even further, which is continuing to push up the bond prices. Again, manipulation, unfortunately. And the Fed has also recently talked about they're going to buy bond exchange traded funds. So you already have a bond bubble the last few years, again, because of artificially low interest rates. And then you have the Federal Reserve buying corporate bond ETFs. You have more money coming into the bond market, which is very concerning. Again, I want to bring that to attention. Again, what you don't know can hurt you. So let's look at some articles. So this is from 3 articles from last year. Look at these headlines. This is from Bloomberg. Bonds meet the 4 criteria for defining a bubble. So again, that's from Bloomberg. Here's another one from Forbes, last fall, 2019. Are government bonds and cash the next big bubble? Look at that. So again, this one's from Forbes. This one is from another well-known financial website. 66 rate cuts, meaning declining interest rates over the last 30 years, fuels dangerous bond market bubble. So it's more of a, what's that going to lead to in the future? And this is this year. This is March 12th, Fortune magazine. The bond bubble may be next to burst. So again, it's a concern that we have and that I'm sharing with you today. If you own bond funds, it's again something to reevaluate. Maybe you don't really realize that there's a lot of risk in the bond market. If you own individual bonds, yes, you can wait to that maturity date to get your money back to the extent the issue is still in business. In some cases they will be, in many cases they won't be, specifically with corporate bonds, especially with economic challenges coming up. So again, I wanted to bring your attention to the bond market and some of the risks in the bond market. Don't put all your attention just on the stock market, which a lot of the media talks about. So to that, if you would like a second opinion on your portfolio or financial situation, if you want us to review your bond portfolio, we're happy to help. You could send me an email at cnichols@nicholswealth.com or go on our website at nicholswealth.com to learn more. Thanks again for watching. Bye-bye.